So we're going to begin by reading through the question, and then we're going to go through the key tips you should bear in mind whenever you are attempting an investment appraisal question. And then we'll quickly get hit to the question by looking at the different parts to that element, with particular focus on the calculation part of the questions, really. So that will be our focus. So let's get right into it. We'll read the question. It'll take a few minutes to highlight a few points that you should note with regards to investment appraisal. All right. At the end of this question practice, you should be able to identify a question that will make use of our investment appraisal technique, NPV, even when the question does not explicitly state so. That's one key objective from this question practice. You should be able to also understand how to apply the concept of expected value as well as the cost of capital. So it sort of gives you a structure. So this session will sort of give you a structure on how to approach investment appraisal question. So let's begin by reading the question quickly. So the question reads, it says Tolu PLC is a multi-divisional company operating in many sectors of the Nigerian economy. All major capital expenditure proposals are appraised and approved or rejected at the group corporate head office. At the moment, Division A and B have submitted the underlisted projects for review. So one of the things I really do when you're reading question is to try and highlight some key information so that you don't have to read it all over when you're trying to answer them. So right here, we're saying that it's talking about Division A and then Division B. And we also looked at the fact here that it's looking at a proposal, an investment proposal, really. So let's look at what Division A's proposal is. The division manufactures household appliances for sale in Nigeria and ECOWAS sub-region. The division is considering the development of a new product with a planned selling price of 10,000. So I know that this is an important information. This is a selling price of 10,000 here. It is expected that the selling price will be held constant over the initial planning period of 5 years. So looking at a project for 5 years. The company is uncertain about the scale of demand at the selling price of 10,000. It is estimated that 2 states of demand are equally likely. So 2 possibilities. The first state, which is state A, and state B. Once the state has been identified, there remains some uncertainty about the actual level of demand as a result of general economic conditions. So they're looking at going into production, but 2 likely possibilities, either A or B, would happen. The future is uncertain, so they've taken note of that. It is possible to commission a market research to discover with certainty whether state A or state B prevails. The manufacturer of the product will require the purchase of a machine. 2 models are available. So they need a machine to even begin to produce. And there are 2 models of the machine. One of the model costs 80 million and has a capacity of 12,000 units per annum. And one costs 120 million and has a capacity of 20,000 units per annum. Both models would have lives of 5 years and no scrap value at the end of that time. In addition to the cost of a machine, the manufacture of the product would involve variable costs of 5,000 per unit and an incremental fixed cost of 20 million. Those are key points to take note of. The division has cost of equity of 20% and cost of debt net of tax of 10%. The target debt to equity ratio is 1. It then says ignore taxation and ignore inflation. So that's for division A. Now let's move on to division B now. It It says Division B, the division runs staff canteens for a number of major corporate organizations in Abuja. The meals are prepared at a central location. The division is in the process of purchasing a new industrial dishwasher. The dishwasher has received quotes from 2 suppliers. So we have two suppliers in there. You have Yarrow and you have Tony. Both quotes meet the necessary requirements. Yarrow is offering a dishwasher that will cost 9 million and has an expected life of 10 years, after which it's expected to have a 200,000 scrap value. The warranty is included for the first year. However, after that, continuing maintenance is available at 5.4 million for a single payment to cover the remaining 9-year life period, or alternatively, for an annual charge of 750,000 payable in advance of the year of cover. Okay, Tony, which is the other supplier, is offering a dishwasher at 7,350,000. This machine is only expected to last 5 years, after which it will have a scrap value of 1.1 million. The supplier offers maintenance services at an annual cost of 720,000 payable annually in advance. The first year's maintenance is covered by the manufacturer's warranty. Division B's cost of capital is 6%. The purchase of the new dishwasher is essential to comply with the new hygiene regulations introduced by federal government to reduce food poisoning outbreaks. Required for Division A, assess and recommend which of the 2 models of the machine should be purchased, if any. In this part, ignore the market research. So that's 18 marks. Then we have the B part, the C part, D part, as well as the E part. So let's start with the A part. So it says, assess and recommend which of the 2 models of the machine should be purchased. So clearly, that requirement tells you that you're trying to compare one machine versus another machine, and you're trying to determine which of them you should purchase. And as a strategic financial manager, you'll definitely be interested in a machine that gives you either the highest return or the lowest cost. But because the machine is being purchased for production, we're interested in a machine that gives us the higher return out of the 2. So that's our focus. So we need to begin to appraise the investment. Now, whenever you're doing an investment appraisal question, so let's look at a number of keynotes of information you try to identify whenever you're doing an investment appraisal question. Key details, quickly. Now, one of the first things you're going to be looking out for in the question would be relevant cash flows. So in other words, when we say relevant cash flows, we're basically referring to cash flows that would occur as a result of the decision to invest or not invest. So if that cash flow will occur, regardless of whether or not you invest or you go ahead with the project, that is not a relevant cash flow. So that is one of the things we're going to look out for. The second thing we're going to look out for is the duration of the investment. So on the relevant cash flow, when we read the question again, we'll try to ask ourselves whether or not it's relevant for our decision. The second thing would be the duration of the project. So let's quickly go back to this our question and even see what is the duration of this investment in machine A and or B, model A and B, which is that investment proposal that is submitted by Division A. What is the duration? So it clearly states here that it is for 5 years. So we know that it's an investment proposal for 5 years. Now, there is one more thing after you identify the investment proposal for 5 years. If the cash flow, when I say cash flow, I mean the sales amount, the variable costs, and other expenses, if it will remain constant over the 5 years, then we can make use of annuity factor to aggregate our performance over the tenure of the investment. However, if it will change, maybe as a result of inflation or maybe as a result of the annual projection, then in that case, we need to present a result yearly. So in that case, we need to present our result yearly. So what do I mean by present yearly? What I basically mean is that we're going to determine what is our performance in year 1, maybe sales, variable cost, contribution, profit. What is our performance in year 2? What is our performance in year 3? And what's our performance in year 4, etc. But if it is constant, we're just going to calculate for one period, which is the first period, and then we make use of annuity factor to cover all the periods that are involved. So let's quickly go back to our question and ask ourselves, when this investment is undertaken, would the revenue, the sales price, would it be constant for 1 year, throughout the tenure of the project, or would it be different for the various years? So let's just peep into our question quickly to see that. Okay, so it says that our sales price will be held constant for 5 years, so we can see that it's going to be constant there. It states somewhere when it talks about our variable cost as well. Okay, but it's a variable cost. I think we have it just somewhere here. Yeah. So it says that the variable cost will be 5,000 per unit. There's no mention that it will increase or decrease, so it's assumed to be constant. It mentions that the incremental fixed cost would be 20 million. So in that case, we'd only be interested in calculating our performance for the first period, and then we make use of annuity factor to extend it over the 5-year period. So let's get right into it then. Okay. All right. So that we don't go back and forth to the question, let me quickly note some of the key elements from our question, the key detail from the question that we need to take note of. Just give me a moment. Okay. So let's just quickly note the key details from the question so that we don't go back and forth on it. Right. So the question tells us a key detail. It tells us at the very start that the selling price is 10,000 per unit. So that's the selling price of our product, 10,000 per unit. It also tells us that when we undertake this investment by division A, it is possible that we will achieve state A or we will achieve state B. So let me just quickly note that down so that we don't go back and forth on it. So our sales price is 10,000. And then there's a possibility that would have state A or state B. So let me write that down quickly so that it's easy for us to do our calculation from down. Okay. So our sales price is 10,000 per unit. Our demand would actually be that we experience state A or we experience state B. And each of these states, we have probability of occurrence for them. So for our state A, okay, so for our state A, we could have demand of 8,000, we could have demand of 11,000, and could have demand of 15,000. The probability of that happening is 20, 60, 20. So let me quickly just write that down. 8, 11, 15. Okay, so state A, we could have a demand of 8,000. The probability of that happening is 20%. We could have a demand of 11,000. The probability of that happening is 60%. We could have a demand of 15,000. The probability of that happening is 20,000. And that is the first state, the first possible option that we have available to us. The second thing that could happen to us is instead of state A happening, state B could happen. And if state B happens, based on our question, would have a demand of 12, a demand of 15, and a demand of 19. The probability is the same, 20, 60, 20. So we have a demand 12, 15, and 19. Okay, so we have a demand for state B of 12,000. It could be 12,000. The probability is 20%. It could be 15,000. The probability is 60%. And it could be 19,000. The probability is 20%. Okay. All right. So this is 20%, not 20,000. All right. So this is 20%. Okay. So that's what could happen in terms of our demand. However, for us to be able to even produce and sell, we need to buy a machine. And that's one of the decisions the company is making. Do we buy machine A or do we buy machine B? So let's quickly note the requirement or the details of these machines. So machine A, the question tells us that machine A costs 80 million and has a capacity of 12,000 units. Machine B costs 120 million and has a capacity of 20,000. So the big decision would be which of these machines do we buy? That's what the question is really focused on. Which of these machines do we buy? So machine A would cost 80 million, capacity of 12,000. Machine B would cost 120 million and it has a capacity of, sorry, I missed that. Let me quickly confirm what that is in the question again. A machine B has a capacity of 20,000 units. 20,000 units. Okay, so it has a capacity of 20,000 units. Our question is, which of these two machines do we buy? Or which do we invest in? That's our question. That's the question. All right, so let's see if there's any other details on the machine again before we begin to attack it under division A. So the other details we have under division A, apart from the cost of capital, which we're going to deal with later on, would be on the variable cost, which is 5,000 per unit, and the incremental fixed cost of 20 million. Okay, so I can just write it down here. Our variable cost is 5,000 per unit, Then we have our incremental fixed cost of 20 million. Okay, so which of this machine should we buy? Now let's begin by considering machine A. And let's see if we buy machine A based on our sales price, our variable cost, and our demand for machine A, what will be our net benefit or profit? And then we compare that with if we purchase machine B. So when we make that comparison, we now decide on which of the machine that, which of the two machine we should go for. All right. So guys, pay attention and let's look at the which of them. So let's begin with machine A. If we purchase machine A at 80 million, what will be the net benefit to us? Now, if we purchase machine A, two things can happen. It is either we have state A of 8,000, 11,000, and 15,000 sales, or we have state B of 12,000, 15,000, and 19,000. Now, but let's look at the expected sales for state A first. So let's begin with machine A first. So when I purchased machine A, which is cost me 80 million, 12,000 capacity, we could have state A happen. So what is the expected demand for state A? Okay, we're going to multiply the demand by the probability, and then we add it up to get the total expected value. However, if you bear in mind one key important detail in this question, when you have a demand versus capacity, your sales for that period would be the lower of the two. So let's break it down. So it will be the lower of the two. So let's explain it quickly, and then we come back to our expected demand for A. If, for example, as a business, you have a demand, customers are able to demand for your product for 11,000 units, but you can only produce 10,000. Quick question, if anyone wants to, what quantity do you think you would be able to sell? Customers are demanding 11,000, but you can only produce 10,000. What quantity do you think you will sell? Can we hear someone's voice who would like to comment on that? What quantity do you think
10,000.
you can sell? You can only sell 10,000. That is the truth. Because even though you have 11,000 demand, you only have the capacity to sell 10,000. So if you produce 11,000, if you even choose to produce 11,000, you can't sell 11,000. You can only, if you choose to, you can't produce more than 10,000. So even if your customers are demanding 11,000, your capacity would not be strong enough for you to produce up to that 11,000. So it is only that 10,000 you can produce, which will be your sale. So what do we mean by that? That it is the lower one that would be your sales. Now let's reverse the rules now. So the lower one would be your sale. Now let's reverse it a little bit, because we said that whenever you have demand versus capacity, the lower one would be your sales. Now let's reverse it. Let's assume that you have a demand of 10,000, but you have the capacity to produce up to 15,000. What do you think will be your sales? You have a demand of 10,000, but your machinery has the ability to produce up to 15,000. What will be your sales? Now, if you produce the entire 15,000, you can't sell the 15,000 because your demand is only what? Your demand is only what? 10,000. Because your demand is only 10,000, if you have capacity to produce up to 100,000, your demand is only 10,000. So that is what you can sell, because that is what is demanded. So you can see that it's also the lower one equals to sales. So whenever you're comparing your demand, which are my various demand here, versus capacity, your sales would always be the lower one. So I should have written expected sales here, not expected demand, rather. Your sales would always be the lower one. So let's now calculate the expected value with that information out of our hands. Let's calculate the expected value for state A. For state A, 8,000 versus 12,000. The lower one is what? 8,000. And the probability of 8,000 is 20%, which is 0.2. Plus 11,000 versus 12,000. The lower is 11,000. The probability is what? 60%, which is 0.6. And then finally, 12,000 versus 12,000. No, sorry, not 12,000. 15,000 versus 12,000, which is 15,000 for state A. We are still buying state A, please. Expected sale for state A. 15,000 versus 12,000. The lower one is 12,000. And the probability is 0.2. All right, so let's add what our expected sales would be for this. So this would be 8,000 multiplied by 0.2 gives us 1.6. 11,000 multiplied by 0.6 gives us 6. 12,000 multiplied by 0.2 gives us 2.4 by my calculator, and the total is 10.6 as our expected sales for state A. All right. If you have any question, just feel free to raise your hand and then I'll call on you to go ahead. Now let's look at our expected sale for state B. Let's look at our expected sale for state B. So let's look at our state B. Okay, so state B, these are the expected demand and the probability. Don't forget we are still in machine A. Machine A can have state A or state B. So for state B, our first expected sales is 12,000. Our machine has a capacity of 12,000. We said that the sales would be the lower one. So 12 gives us 12,000. So that would be 12,000 multiplied by 0.2 plus our next demand for state B is 15,000. Our machine A has a capacity of 12,000. And we said that whenever you're comparing demand against capacity, the lower one is your sales. And we explained that concept. So 15 and 12, the lower one is 12. So that's 12,000 multiplied by 0.6. Then finally, 19,000, the probability is 20%. So this is 19,000. Our machine has a capacity of 12,000. We will go with the lower one, which is 12,000 multiplied by 0.2. Now this is this. If you add everything up, it will give you 12,000. I don't have to add it up individually because I know that this is 12, and this is 0.6, 0.2, 0.6, 0.2 is 1. So 12,000. All right. So our expected demand for state A is 12.6. Our expected demand for state B is 12,000. We need to determine what the return would be for model A. So we need to find what is the overall expected demand before we begin to plug in the figure. What is our overall expected demand? What is the probability that state A will happen? And what is the probability that state B will happen? Let's go to our question quickly. Our overall expected sales, rather. Okay. What is the probability that state A will happen? Well, we said one of the two can happen. So what is the probability that A will happen, and what is the probability that B would happen? It states here, right here, it says it is estimated that two states of demand are equally likely. In other words, both have a 50% chance of occurring because they are equally likely. So let's use that to calculate what our overall expected demand would be. And then with that information, we can calculate what to expect from machine A, which is the first machine we're calculating for. So expected sales for state A is 10,600. It has a 50% chance of occurring because they both have equal chance of occurring. The expected sale for state B is 12,000. It has a 50% chance of occurring. So that would be 12,000 multiplied by 50%. Okay. So this would be 50% of this would be 5,300. And 50% of this would be 6,000. And that gives us a total of 11,300 as the overall expected sales. If you have any question up to this point, please feel free to ask. Okay. So let me look at what I've just done now. So whenever you have sales and you have a machine that has a defined capacity, you have a demand, sorry, you have demand and you have a machine that has a fixed capacity. What you can sell will be the lower of the two, and we explain that concept. The second concept you should note is that whenever you have expected values, to get the expected sales from the expected value or percentage, you need to multiply the individual amount of volume by the percentage expected value. And that's what we did for all of the different levels, and then we summed it up. And then we then calculate the overall value. So now with that done, let's now calculate what machine A will result for us. Now that we've calculated what the expected value is, expected sales is for machine A. So let's see how that adds up to our figures. All right. So we're going to, if we buy machine A, we're going to sell 11,300. So we are in machine A. Machine A, we're going to have a sales of 11. Okay, you want to ask a question?
Yes, sir.
Okay, please go ahead.
I'm seeing that for B, the capacity is 20, and then the demand is 19.
No, don't mix it up. We have two machines, machine A and machine B. We are in machine A now. Now, whether you buy machine A or you buy machine B, you will definitely use that machine to produce something, right? And you're going to sell. Now, when you buy the machine, you might find yourself selling under state A. So I buy the machine and state A happens to my company. So I end up selling, having the expected value of 8, 11, 15 based on my demand, projected demand. Or with that same machine A, you might have 12, 15, or 19. Is that clear? The same thing with the second machine. When I decide to buy the second machine, I might have a state where I buy the second machine and I will experience state A demand, which is 8, 11, 15, or I'll have state B demand, which is 12, 15, and 19. I hope that's clear. Hope that's clear?
Yes, sir. Yes, sir.
Okay, great then. Okay, so we're going to still do the same thing we've just done for machine B as well. We're going to do the exact same thing for machine B, but we're now in machine A. So we've calculated the overall expected demand. So we've said that the overall expected demand is 11,300 for machine A. So 11,300 units. What is our sales price from the question? I think we wrote it down somewhere so that we don't have to go back over and over. It is 10,000 naira per unit. So multiplied by 10,000 naira per unit. Okay. So what does that give us? Let's get this out. So that's 11,300 multiplied by 10,000 gives us 113 million. With less our variable cost to get our contribution. And we clearly mentioned in our question our variable cost, to which we copied and pasted as well, was our variable cost, 5,000 per unit. So that would be, our unit is 11,300 as well, multiplied by 5,000. Okay, so that will give us, that's about half of 113 million. So that's 56,500. Okay, so sales minus variable cost gives us our contribution, which would be the same thing, 56,500. Okay, we now less our fixed cost. So this is machine A for year one. Okay, so we now less our fixed cost, which is our incremental fixed cost, which is what we're interested in, which is the additional fixed cost from our decision. Our incremental fixed cost is 20 million. It's 20 million. Okay, so that gives us profit before tax of 36,500. Now at this point, if we have taxation, we're going to charge tax. But the question tells us that there's no tax. Well, let me just put a placeholder here, just in case you have taxation in your question, you're going to bring in tax here. The question tells us, let's quickly look at that in the question quickly. Yeah, I think somewhere here. Yeah, it tells us ignore taxation and inflation. So we're going to just ignore and assume that there is no tax. So taxation and inflation. Okay. All right. So this is our tax. So there's no tax. If there was tax, we'll subtract tax. So the question says we should ignore it. So that gives us 36,500 as our profit. Now don't forget, Tolu, just hold on a little bit. I'm going to come to you soon. Don't forget that this is for 1 year. And we mentioned at the onset that if you have, when we began our class, we mentioned that if you have your sales, your variable costs, your fixed costs constant over the tenure of the project, we're going to use annuity factor to extend it over the tenure. But if it changes every year, in other words, the sales in year one will be different from the sales in year two, the variable cost in year one will be different from the variable cost in year two, and so on. We're going to do this same calculation that we've just done right now, because this is just year one. We're going to do it for year two, year three, year four, etc. But because ours is fixed, we don't have to do that. So we're going to just use annuity factor to extend it. So let's determine what the annuity factor is. But before I do that, let me take a question from Tolu. Tolu, go ahead.
Good morning, sir. My question is that the inflation aspect of it, what if there is inflation? What are we going to do?
Okay, so if there is, like I said, if the value changes, so if there's inflation, the value has changed. And that's what I explained here. I explained here that if the value changes, so if the value changes every year, then, and if the tenure of the project is within a reasonable time period, you can use your 1 year, 2 years, 3 years to show the growth year in, year out, because definitely tax will be different for every single year. That's what you would use ordinarily. Okay, is that okay? There is another method, but I don't want to go right into that because I want to focus on just this question. Hope that's clear.
Yes.
Yeah, if I go off, you're going to take my time. But generally, if the value changes, if the value is going to change, just present it for the different years. That would be our right approach. Okay, So let's determine our annuity factor. Let's do our what do you call it, our calculation for annuity factor. Now, don't forget our formula for annuity factor. It is 1 minus 1 plus whatever the cost of capital is, or the rate of return, raised to the power of minus n, which is the number of years, divided by the rate of return as well. That's what we're going to use for annuity factor. So that therefore means that we need to know, sorry, where's my pen? That means that we need to know what R is, and we need to know what N is. And N is the number of years. Return tells us that these projects or sales remain constant for how many years? Clearly mentioned in the question. It says it will be for a period of 5 years. I wrote it down here, for a period of 5 years. So our N is 5. So that leaves us with calculating what the rate of return or the cost of capital is. So our N is 5. So that's pretty straightforward. It is 5. So that leaves us with what our rate of return is. Now, if the company has just one source of finance, they'll give you the cost of capital, or the cost of what the cost of capital is. However, if the company has more than one source of finance, oftentimes they will give you what the cost of the different sources of finance is. For example, for this question, if you come right here, it mentions that the division has the cost of equity at 20%, the cost of debt at 10%. So the company is financing its business through equity and through debt. So because you have two sources of finance or more than one source of finance, you need to calculate the weighted average cost of capital, because you have more than one source of finance. If you have just one source, you just use the rate for that source. So we need to calculate our weighted average cost of capital. So that's what we're going to do. Once we've done that, we can plug it into our formula. So let's calculate our weighted average cost of capital somewhere here. Okay. All right. Now, there are different formulas for calculating WACC, but the one I generally like using would be that your weighted average cost of capital would be your cost of equity multiplied by the value of equity divided by the value of equity plus value of debt, plus the cost of debt 1 minus T, which is basically net of tax, multiplied by the value of debt divided by the value of equity plus value of debt. The question gives us all of this information. It tells us that the value of equity is 20%. Let's clearly read that quickly again. It tells us that the cost of equity rather is 20%, and the cost of debt net of tax is 10%. It also tells us that the debt to equity ratio is 1. So a debt to equity ratio of 1 basically implies equal proportion. Debt to equity ratio of 1 implies equal proportion, which is 0.5, 0.5. So with that said, let's plug it in. Cost of equity 20, cost of debt 10, debt to equity ratio of 1, which implies half, 0.5 equally 0.5. So let's plug it in quickly to get our WACC quickly. So once we've done that, we can just apply it in subsequent other questions. So that would be our cost of equity is 20% multiplied by value of equity, which is 0.5 divided by 0.5 plus 0.5 plus cost of debt net of tax. So the way taking care of the tax, 10% multiplied by value of debt, which is 0.5 because it's equally, divided by 0.5 plus 0.5. So 20% multiplied by, this is 1. So 20% multiplied by 0.5 will be 10%. 10% multiplied by this, 0.5 divided by 0.5 plus 0.5 would be 5%. We give a total of 15%. Okay, so our R is 15%, which is basically 0.15. Okay, so can we plug it into our formula now to find what our negative factor is? So that would be 1 minus 1 plus R, which is 0.15, raised to the power of minus n, which is 5, divided by 0.15. Okay, so what would that give us? You can use a calculator. You can solve them individually. So what I will do is I will do 1 plus 0.15 raised to the power of minus 5. I subtract 1 divided by 0.15, but I ignore the minus sign because I'm solving it backward. So by my calculator here, I have 3.352. If anyone is struggling to get this answer, you could just let us know. You could just let me know. But it's just basically solving this. So you can solve this one, then you subtract 1 from it, and then you divide it by that. So that gives us a total of 3.352. So 3.352. Okay. So what is our total inflow for year 1 to 5? Now that we have extended it with the annuity factor. 36,500 was just for 1 year, but we use the annuity factor to extend it to cover the entire 5-year period. So that will be 36,500 multiplied by 3.352. So that gives us 122,348. 122,348 million. So this is what we will get from machine 1. But machine 1 will cost us money. How much will it cost us? How much will it cost us to purchase machine 1 or machine A? We call it machine A. Okay, so it's going to cost us 80 million. That is what it will cost us to purchase machine A. So we take off what we will use to buy machine A, which is 80 million. What does it leave us with? Our net benefit is 42,348. Any question on this part? Because when we do machine B, it's going to be very fast and straightforward. We're not going to calculate the work again because we've already calculated it. We're not going to calculate, yeah, that's basically all this, but we're going to calculate what the demand would be under machine B because machine B has a different capacity compared to machine A. Is there any question on machine A? Okay, let's do machine B. Let's do machine B. So that we can purchase machine A at 80 million, we'll make a net benefit of 42,348 million. Let's look at machine B, which is the second one. We're going to compare the two and then advise our company on which of the two to go for. So if you miss the first part, we're basically doing almost the same thing again with machine B. So let's look at machine B. Now, machine B will cost us how much? Let's revisit the question. Machine B will cost us 120 million, but it will have a capacity of 20,000 units. Machine A had cost us 18 million, but had a capacity of 12,000. Machine B will cost us 120, will have a capacity of 20,000 units. So that would be, okay. So it will cost 120 million, but it will have a capacity of 20,000. So the big question is if we buy machine B, what will be our sales? We don't tell you that whatever you do, two things can happen to you. It's either you find yourself under state A, where your demand would be 8, 11, 15, or you find yourself under state B, where your demand will be 12, 15, and 19,000. So, and we said, when you are comparing demand versus capacity, what would be your sales? Which of the values would be your sales? Can someone quickly remind us, just to be sure we're all in this? When you're comparing expected demand versus the capacity of your machine, based on our explanation earlier, what would be your sales? Which of the two values, the lower one would be your sales? So please take note of it. The lower one would be your sales. We'll explain why. If you missed that, you might want to quickly catch up on the video and watch that. So let's now look at what our sales would be for machine B based on state 1. So based on state 1. So 8,000, capacity of 20,000, 8,000 the lower one. 11,000, capacity 20,000, 11,000 is the lower one. 15,000, capacity 20,000, 20,000, 15,000 is the lower one. So let's apply the probability to those different values to get our expected demand. So that would be 8,000 by 0.2, 11,000 by 0.6, and 15,000 by 0.2 for state A. Because those are the lower values when compared to the capacity of 20,000. So that would be 8,000 by 0.2 plus 11,000 by 0.2 plus, 0.6, 60%, plus 15,000 by 0.2. So multiplying it by the probability. Okay, so we've already done 8,000 and 11,000. It doesn't change from the one we did before, which were 1, 6, and 6, 6. So that doesn't change. So this is 1, 6 plus 6, 6. But the 15,000 changes because in machine A we used 12,000 because 12,000 was the lower one. But so 15,000 multiplied by 0.2 gives us 3,000. Okay, so that's 1, 6 plus 6, 6 plus 3,000, which is 11,200. Okay, so let's do state B. Same thing. The demand versus our capacity. Our sales is the lower one. So for state B, our demand could be 12,000 versus 20,000. 12,000 is the lower one. It could be 15,000 versus 20,000. 15,000 is the lower one. Or it could be 19,000 versus 20,000. 19,000 is the lower one. So we're picking everything there, 12, 15, 19, because those are the lower ones as compared to our capacity. So that would be 12,000 multiplied by 0.2 plus 15,000 multiplied by 0.6 plus 19,000 multiplied by 0.2. Okay, so let's get that in quickly. So our 12,000 multiplied by 0.2 is 24. Plus our 15,000 multiplied by 0.6 is 9,000. Then finally, our 19,000 multiplied by 0.2 is 38. So that would be 24 plus 9,000 plus 38 gives us a total of 15,200. This is state A and this is state B. We need to find the overall expected sales, just like we did on the machine A. What is the probability that state A will occur and what is the probability that state B will occur? We did that under machine A, but let's remind ourselves. We found the expected value for state A, we found the expected value for state B. What is the probability that A will happen and what is the probability that B will happen? Let's highlight that again. We did that with machine A, but let's quickly show it again. It states right here that it is estimated that two states of demand are equally likely. So they both have 50% chance of occurring because they are equally likely. Let's get our overall demand then, or the overall sales rather than quickly. They both have a 50% chance. So that would be 50% of 11.2 plus 50% of 15.2. Okay, so what do we have? All right, so right into it, 11.2 by 50% gives us 5.6. Plus our 15.2 multiplied by 0.5 gives us 7.6. Okay, so that's the total of 13,200. That's our overall expected demand for machine B. Now let's do our net benefit from machine B. This same exact thing that we did for machine A, we're going to do it for machine B. So let's begin with our sales. So that's for our machine B. So the exact same thing we did for A, we would do for B. This is our year one. So let's begin with our sales. Our sales is 13.2. Our sales price for per unit is 10,000. The same thing, it doesn't change. So multiply by 10,000. Gives us 132 million. Less our variable cost, which is the same 13.2 multiplied by 5,000. Okay, so what do we have? $13.2 multiplied by 5,000. So that gives us 66 million. Okay, that gives us 66 million. So this minus this would give us 66 million. That's our country contribution. Okay, our fixed cost does not change. Okay, can I put it here? Yeah, I can put it here. Our fixed cost does not change. So we have our incremental fixed cost of 20 million. And that gives us profit before tax of 46 million. There's no taxation. We explained it before. There's no taxation, but let me just put a placeholder just in case you have tax in your own. If the case they repeat the question and I can decide to put tax, you bring in tax there. There's no tax. So we have the same 46 million. And this is for year one. So just like we did for machine A, we need to bring in the annuity factor. We've already calculated it, so we don't have to calculate it again. That is 3.352. So we bring in our annuity factor, which is 3.352. So we multiply it, and we have 154,192. Okay, as our benefit before we pay for the machine. Now, how much will it cost us to purchase machine model 2? Of machine B is 120 million. Okay, so what's our net benefit? Our net benefit is 34,192. Okay, so let's summarize. If we do machine A, it is our net benefit. So if we do machine A, our net benefit from a calculation would be 42,348. If we do machine B, a net benefit would be 34,192. So our question A states, which of the two machines should be invested in? Let's get the exact word. Yeah. So which of the two models of the machine should be purchased? So guys, which of these two models should be purchased? Which of the two models? Clearly, we're businessmen, so we go for the one that gives us a higher benefit. So clearly, from this analysis, machine A gives the higher return and should be purchased. All right, guys, just look through what we've just solved. Do you have any concern, any question on any of the steps that we took? Guys, I want you guys to be able to, if you have any question that has expected value, that has a fixed amount over a number of years, I want you guys to be able to get it right. I want you guys to be able to get it right. Any question? Okay, so please take note of the steps that were explained, especially the key points. Let me take it one more time. The key point you should take from this question. One, we said when you have your values, your sales, your variable costs given to you for different values, different years, then you need to do your computation across the number of years. So if it's 5 years, you do what year 1 revenue is, what year 2 revenue, and whatever the values are, what year 3, what year 4, what year 5 is. However, if the values are going to be constant over the entire duration of the project, then you only need to compute for year 1 and apply the concept of annuity factor to extend the computation over the tenure. That is one key thing you must take away from this example we've done. The second thing is, whenever you have expected value and you have the sales or the variable value, to know whenever you have expected demand and you have this, for you to know the value to apply, you need to multiply the volume that is projected by the probability of occurrence. And that's what you need to do. So if there are different or possible occurrence with different probability, you need to multiply them and add them up. That gives you the expected value to use. That is another key point you should take note of out of this illustration. Thirdly, whenever you have a question that gives you capacity of a machine and gives you demand, your sales would always be the lower one. And we explained it. If you need to watch the video again, please just get back, get in when it's ready and watch it so we don't go back. But the key point is the lower one would be your sales. And the reason for it is explained in this video. All right, so let's move on to our B part of our question and see if what we can do within the next 20 minutes that we have for this session. All right, so we're going right to B part of the question. If there are no B question, if there are no questions on this one. Okay, the B part says, if the market research is undertaken, recommend the maximum sum Division A should be prepared to pay for the market research survey, assuming the decision will be based on a calculation of expected net present value. So what do we mean by that? What we're basically saying is that, in this first part A, the company doesn't know whether it will be state A that will happen or it will be state B that will happen. Now, a researcher has come to you, a market researcher has come to you and say, I can give you information that will help you determine whether it will be state A or it will be state B. The question is, what is the maximum amount you would be willing to pay that researcher or that analyst for that job? Based on the information we have right now, if we go for machine A, we're going to make 42,348. How much are we willing to pay to get an information that pinpoints which of the two is the exact one to go for? That is what the second question is about. What information would we pay? Now, if you have information that gives you the ability to project which state would happen, all you just need to do is to go for the state that gives you the best benefit. Okay? And what do I mean by that? Let's look at the B part. What we're basically saying is that with perfect information, the company will simply pick the option with the best result. So what that means basically is for us is that we need to begin by asking ourselves, what are the possible options, so that we can calculate what the benefit would be from all of those possible options. All of those possible options. Once we know what the benefit will be from all of those possible options, we can then decide to say, out of all of them, this is the best and this is the one we would go for. Then we can then compare that with what we already know and see how much are we willing to pay to the guy for that information. So let's look at all the possible options that we have. So we need to begin by determining the all possible options. That will be our first step. First step is to identify all possible options. That's our first step. Okay, so we have two machines. So we have machine A and we have machine B. We have our state or possible options out of those that can happen. There are the two options that we have, like these two state of things that can happen. Is either we have state A, and then we have, let me not use AA so it doesn't confuse guys. So I can just use, for the machine, maybe I can use small and big, so that it doesn't confuse you guys to say why AA. So we have the small machine that is 80K, which I refer to as machine A, my calculation above before. And then we have the big machine, so to 80 million. And then we have the big machine, which is 120 million. Good. We have state A and state B. Now, what are all the possible options? Let's look at what the possible options are. Now, let's pay attention. We'll do all the possible combination. You might buy the small machine and state A would happen. That's one option. You might also buy the small machine, and instead of state A happening, what state will happen? State B. The same thing for the big machine. We might buy the big machine and state A will happen. We might also buy the big machine, but instead of state A happening, state B will happen. Did we miss any option? Did we miss any possible combination beside these ones? I don't think so, because there are 4. There are 2 here, meaning there's going to be this, either this to this, or this to this, either this to this, or this to this. So those are all the possible options. And the guide that the teacher tells us that I can give you information that will tell you which of the option to go for. So that means that for us to know which of the option to really go for based on that information, we need to calculate what will be the benefit from all of these options. What will be the benefit from all of these options? That's basically our first step. Okay, so let's get right into calculating what the benefit would be from all of these options. So, sorry, I need to scroll down. Okay. Okay, so I have okay, so I can call this, maybe I can call this, just to streamline it, I can call this option 1, I can call this option 2, I can call this option 3, I can call this option 4. So when I mention option 1, I'm basically referring to a situation where you buy a small machine and you experience state A. So let's get it down. Let's calculate the calculation then. So let's put it here. So option 1, option 2, option 3, and option 4. Because there are so many, let us take off 3 zeros from our calculation so that it's easier to manage. So I'm taking off 3 zeros. Okay, all right. So let's begin with our sales. Small machine, which is the machine that cost us 80 million. What is the expected demand under state A? We did a calculation. Let's go back and pick it. Let's go back. Let's go to our small machine calculation and pick it. We did it, so we don't need to do it again. So our small machine is machine A. I just renamed the small machine so that it's easy to understand. So this is our machine A, which is a small machine. Our expected demand under A is 10.6. This is our small machine, which is machine A. Our expected demand under B is 11.3. So let me go to small machine, which is and then under A and under B, we have our demand given to us under those values. Right, so let's go right to that. So that's, sorry, let me pick that again, 10.6. Sorry, let me pick that again quickly. So that's 10.6 and 11.3. So small machine A, 10.6, small machine B, 11.3. 10.6, 11.3. 10.6, 11.3. 10.6, 11.3. Okay, so small machine A is 10.6. Small machine B is 11, 3. Let's go to the other ones, big A and big small, and big B. So we're just going to pick the value. We've done the calculation before. Oh, sorry, that's small. So while we're on the, yeah, this is the big one, which is machine B. So big A is 11.2, and big B is 15.2. 11.2, 15.2. So this is, sorry, let me reconfirm that again. Big 11.2, yeah, 11.2, 15.2. 11.2, 15.2. Okay, that's the most important value in this calculation. So let me quickly reconfirm that I didn't pick the wrong value from it. Let me quickly confirm. So small a is 10.6. So small, which is the one we did when we did machine A, small, which is the machine, which is this. Yeah, so this is small. A is 11.6. Okay. That's small a. Small b, sorry, 10.6, rather, is 10.6. Small b where's small b? Oh, sorry, small b is here. I was looking at this overall. So small b, let me not mix it up. So small b is 12,000. Small a, 10.6, small b is 12,000. So I need to correct it. I was looking at, I picked this overall rather than small b. And then the big A is 11.2, big B is 15.2. So the other one should be 12,000, please, guys. Should be 12,000, guys, not 11. So this is 12,000, guys. Okay, so the other steps are just pretty straightforward now. The other steps are pretty straightforward. We know what the cost would be and all of that. So let's get that in straight. All right, so our sales price is 10K per unit. 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 Okay, I might have to maybe take off more zeros so that I can have space for it. So 10.6 multiplied by 10,000, 106 million. So if I take off 3 zeros, 106,000. So this is 106,000. This is 120,000. This is 112,000. This is 152,000. But let me pause a little bit because the sales is actually the most important part of this big calculation, really, for us. Does anyone have any concern or any question on how we picked those values? You can ask if you have any question, any concern on how we picked those values. That's the main thing. Once you get that right, the other steps are pretty straightforward. Okay. So what we're basically doing is we're saying that if someone is going to give us information, the information will help us to pinpoint which of those options will be the right, which of those, we pinpoint which of those options will happen. So we need to know what the values would be so we know what the best options are. So based on that, we then determine, is it even worth paying for additional information or not? Okay. All right. So if that's clear, let's move on. The other ones are pretty straightforward. Let's bring in variable costs and all the rest. It's pretty straightforward. Less variable cost, which is so variable cost is basically 5,000, 10.6 times 5,000 per unit. The other ones are pretty straightforward. We're just copying what we've used before, which is 10.6 multiplied by 5K per unit. For this guy, it is 12K multiplied by 5K per unit. And for this guy, it is 11.2 multiplied by 5K per unit. And for this guy, it is 15.2 multiplied by 5K per unit. Okay, so that gave us, that would basically be like half of it. So 106,000 divided by 2. This would be 53,000. Okay, so our contribution would be 53,000. This is 60,000 because that's half. Our contribution would be 60,000. The other one, clear, 11 to 112,000 divided by 2. So, which the other, this will be 56,000. This would be 56,000. And then the last one, okay, 76,000. And this is 76,000. So every other thing will just come into place. So after that, we have our fixed cost, which is how much? Our fixed cost is 20,000. So regardless of the state that happens, we would incur fixed costs. We just need to know which of the options to pick. So our fixed cost remains constant for all of us, which is 20,000, 20,000, 20,000, and 20,000. Okay, so that gives us, so we'd have our profit before tax, okay, so which would be this minus this, give us 33,000. This minus this gives us 40,000. Let's get mindful of time. This minus this gives us 36,000. This minus this gives us 56,000. Okay, if we have taxation, we will bring it here, but our question does not have tax. Okay, so therefore, we would have 33,000 here. We have 40,000. We have 36,000, and we have 56,000. Okay, let's wrap up quickly. Yeah, so that's for 1 year. To extend it over the 5 years, we bring in our annuity factor, which is this 3.352. So our annuity factor, which is 15%. Our annuity factor at 15% is 3.352. Okay, so what's our net benefit? And then we can call it a day at that point. And the next class, we would continue from there. I just want to take a few minutes to take questions if there are any. Then we could finalize this question fully, which will be this and the C part, the last part, the calculation part. Okay, so let's get a calculation in quickly. So 33,000 multiplied by 3.352, which is 110,616. 40,000 multiplied by 3.352, 134,080. 36,000 multiplied by 3.352, 120,672. And finally, 56,000 multiplied by 3.352, 187,712. Okay, so let's pause at this point. We've almost done with the B part of the question, but I just wanted to pause. And okay, one more thing, we've not brought in our investment. We're not going to get this money without spending money now, guys. You didn't remember our investment, that last part, but we're going to leave it there. Our investment, because we need to buy the machine. We missed out that part. Okay, so let's feed it in. So the first two, which is option 1 and option 2, are for the small machine. So that's 80 million, 80 million. So that's 80 million. So taking off 3 zeros, 80 million. And then the last 2 are for the big machine. So 120, 120. Okay. So in that case, let's just call this net inflow. Okay, so this will be our net benefit now. Okay, we can take it up from there in the next class. All right, so in the next class, we're just going to take it up from here, and then we'll finalize this and the calculation question, which is the other calculation question, and then we'll finalize this part. All right, so guys, any question on what we've done so far? Please, you can make use of the hand raise feature if you want to ask any question. Okay, any question? Okay, so let me do a parting word for you guys on this. Whenever a question tells you that to calculate maybe the value if there is a research that gives you perfect information, but the question asks you to determine what you would be willing to pay for information that allows you make better decisions. The first step you would take would be to identify all the possible options. And that's what we did, because the information would allow you to choose an option that maximizes the benefit, because that information will tell you which of the options will work. So you can then pick the right one. So we need to begin by determining what are the various possible options. After identifying the possible option, in this case, we looked at machine and the different states. So machine A can happen with state A, or machine A with state B, or machine B with state A, machine B with state B. We look at what is the benefit from all of these possible options. We can then make a decision, and then we can then calculate how much we think we can pay for that information if required. Okay, guys. All right. So it's 6, and I guess it's a good time to call it a day on our session. Thank you very much, guys, for your time. I'll have these videos uploaded to our channel as well, so you guys could always go back and rewatch. And in our next class on Saturday, we're going to finish a consideration of this question. We just have a little left, just the B part of the question, and then just a few minutes on this B part, and then the C part, which is very short. We'll then move on to our next topic, which based on the plan that we have in the group. Thank you so much, everyone, and enjoy the rest of the day. Thank you, guys.
Thank you, sir.
Thank you.